Every dollar in your wallet, every mortgage payment, every stock market rally is touched by one institution. It doesn't run for office, it doesn't campaign for votes, yet it controls the price of money itself. This is the story of the Federal Reserve. In the early 1900s, America had no true central bank. Financial panics were common. Banks collapsed regularly. Depositors lost everything overnight. Then came the panic of 1907, a market crash that froze the banking system. One man stepped in to stabilize the chaos: J.P. Morgan. Morgan organized private bank rescues to prevent total collapse, but the message was clear. The United States needed a permanent lender of last resort. In 1910, powerful bankers and politicians met secretly on Jekyll Island, Georgia. Their goal? Design a central banking system. 3 years later, in 1913, Congress passed the Federal Reserve Act, and Federal Reserve was born. Its structure was unique: public and private elements combined, regional Federal Reserve banks, a central board in Washington, independence from direct political control. The mission? Stabilize the banking system, control the money supply, prevent panic. Then came the ultimate test. In 1929, markets crashed. Banks failed by the thousands. The Federal Reserve failed to inject enough liquidity into the system. The result? The Great Depression. Unemployment soared, businesses collapsed, deflation spread. Critics argue the Fed tightened policy too aggressively. The lesson learned: in crisis, liquidity is survival. Over the decades, the Fed evolved. It gained tools: open market operations, reserve requirements, the federal funds rate. By adjusting interest rates, the Fed influences borrowing, spending, investing. Lower rates stimulate growth. Higher rates slow inflation. After the 2008 financial crisis, the Fed introduced quantitative easing, purchasing trillions in government bonds. Money wasn't printed physically, it was created digitally. Balance sheets expanded, markets surged, debt levels climbed. Today, under leaders like Jerome Powell, the Federal Reserve manages the world's most important currency. The US dollar is the global reserve currency. When the Fed raises rates, emerging markets feel it. Stock markets react instantly. Global liquidity shifts. The Fed is no longer just America's central bank. It is the anchor of global finance. In 2020, during the pandemic crisis, the Fed expanded its balance sheet at unprecedented speed. Trillions entered the system. Markets rebounded rapidly, but inflation soon followed. The Fed then reversed course. Rates rose sharply. Housing cooled. Stocks fluctuated. Borrowing costs surged. This is the paradox of central banking. Stimulate too much, inflation erupts. Tighten too hard, recession follows. The Federal Reserve does not create wealth, it creates liquidity. It sets the price of debt. And in a system built on credit expansion, controlling debt means influencing everything. Modern economies depend on growth. Growth depends on borrowing. Borrowing depends on interest rates. Interest rates depend on the Fed. The central bank is not a villain, nor is it a savior. It is the stabilizer of a system that cannot function without expansion. In the early days, money was gold. Then it became paper. Now it is policy. The Federal Reserve doesn't control your destiny, but it shapes the environment in which destiny unfolds. Every boom, every bust, every bubble echoes from one institution adjusting one lever: the price of money. Because in the age of debt, the most powerful force in the economy isn't production, it isn't labor, it isn't even capital. It's control over credit. And that control sits quietly inside the Federal Reserve.